Oh, are we live? Excellent. Hi, everyone. Thank you so much for coming to this panel. This is Off the Sidelines, New Wealth, Impact, and Underrepresented Investors. And I don't know how many of you had the opportunity to listen to the podcast this year, or I guess last year, 2019, but we do have 10 episodes out. So if you haven't listened and you want to, after you have a chance to hear our great panelists speak, then you are absolutely welcome to go and check out all of those episodes. My name is Abby Lee Mosconi. I am a contributor at Technically, and I write the weekly jobs newsletter, aptly titled This Week in Jobs. And just so everyone knows, this will be captured by graphic recording by Terry Laban at Breakthrough Visuals. For those of you who've been to other events during Philly Tech Week, you see these huge billboard style renderings of events that happened and all of the great information that was shared. So that will still be happening, just digitally. So just to give some feedback, I'd rather word feedback. Just to give a little bit of background, last year, we here at Technically launched a pilot podcast with Project Entrepreneur, a program supported by UBS. And it's a guide to getting into early stage investment. So CEO Chris Wink and I spoke to 10 really interesting founders and or managing partners of funds about how underrepresented investors are investing new wealth and making an impact on underrepresented founders. So throughout our podcast, we talked about how to get involved with investing, especially if you're new, and how much impact there is to be made when you invest in founders that don't fit the traditional mold, so i.e. white males with prominent networks, and therefore haven't traditionally been recipients of funding. But since those discussions, obviously a lot has changed. So today we would love to discuss more specifically how people can get involved in investing at a moment like this during a global pandemic when our economy is in decline and so much has shifted. So with that introduction out of the way, I would love to introduce our panelists. First is David Hall, Managing Partner at Revolution's Rise of the Rest Seed Fund. David, please introduce yourself.
Thanks, Abby. It's a pleasure to be here with everybody, and it's definitely an interesting but wonderful pleasure to be in this forum. Our Rise of the Rest Seed Fund is a place-based fund. We're based in Washington, D.C., but we're dedicated to investing in entrepreneurs all across the United States, except for those in San Francisco, New York, and Boston. We really believe in regional entrepreneurship. Our portfolio spans cities as large as Los Angeles to as small as Moorhead, Kentucky, and all places in between. And we're really proud of the portfolio that we've built. About 40% of our investments are in entrepreneurs of color or women entrepreneurs, which is, we think something that's still not where it needs to be, but we think it's a pretty significant differentiator from a lot of the other venture capitalists. We're seed stage, so we invest early, and we really recognize a lot of the challenges that entrepreneurs have in some of our rising markets getting their first real institutional round put together. So it's a pleasure to be here. Happy to talk about this and really looking forward to the conversation.
Great, thank you. Happy to have you. Next, we have Tracy Chadwell, founding partner of 1843 Capital. Tracy, please introduce yourself.
Hi, I'm Tracy Chadwell. 1843 is a venture capital fund that is early stage focused on technology companies. The name 1843 comes from the year that Ada Lovelace wrote the first computer program. We just like to give a nod to the fact that women have been in tech for a really, really long time. And we like to joke, what would happen if Ada had been funded? We focus on enterprise software companies broadly, but more specifically, we are very interested right now in companies that are focused on technology for the aging. We view that as a really interesting and large market. In terms of our founders, 100% of the founding teams in our portfolio are diverse founders. We have made 7 investments to date out of a planned 14, so we have half of our dry powder left in Fund 1 to spend.
Wonderful. Thank you so much. Next, we have Angela Lee, founder and CEO of 37 Angels.
Hi there. So my day job is a professor and chief innovation officer at Columbia Business School. So I teach venture capital courses and leadership courses. And I started 37 Angels about 7 years ago, specifically to support the need to get more women investors in the ecosystem. And so we have about 85 investors. Every year we look at 2,500 companies and invest in 10. And the part that I'm really passionate about is we have an educational boot camp that teaches women how to do angel investing and venture capital investing so that we have more women writing checks, which we think will help diversity across all different levels.
Fantastic. Thank you, Angela. And last but not least, Astrid Scholz, co-founder of Zebras Unite.
Thanks so much for having me here. It's a pleasure to be in this group on this panel and joining you all from the comforts of my home in Portland, Oregon. I am a tech entrepreneur turned movement builder, I guess, or tech entrepreneur and movement builder. I made a mid-career switch to becoming a tech entrepreneur. And as a woman who's not in her 20s, not a Stanford grad, immediately ran into some of the usual problems with raising money while not fitting a certain pattern, and found myself becoming, among other things, a co-founder of Zebras Unite, which is a global movement to create the capital, culture, and community that entrepreneurs of all different stripes deserve to build the companies of their vision and dreams. And at Zebras Unite, we are about to launch our own capital fund in recognition of some of the unique needs that people have that are not currently represented in the VC world.
Awesome.
Pleasure to be with you all.
Pleasure to have you. All right, before I start asking questions, I just want to make sure that everyone who is watching and listening today knows that you can ask questions of the panelists in the chat box, and I will read them out loud if I think any are applicable to what we're talking about. So please feel free to ask all and any questions that you might have. All right, let's just dive into the deep stuff right away. What would you all say is, how has early stage investing and impact investing changed today compared to, say, last fall or even just February? It's a loaded question.
Yeah, I'll start. I mean, I think it is. I think obviously none of us could have foreseen this pandemic, this crisis, and I think that the state of investing is kind of in flux right now. Where I think you see a lot of investors sort of, having conversations with their existing portfolio. And frankly, a lot of those conversations it was the best of times, it was the worst of times. There are a lot of companies that are really challenged in trying to figure out how do they sort of adjust their core business plan and sort of extend the runway as far as possible while still being very fair to employees and thoughtful about sort of customer reaction, if their customers are businesses or their customers are consumers, to having a product or a service that requires either some sort of retail or supply chain dependence. And so I think that's one phase. The second phase are the companies that are actually able to lean a little bit into this opportunity as a way of having of clearing the path for them to have more direct conversations with their customers or suppliers in a way that they hadn't been able to before. And frankly, one that's a little bit cheaper and a little bit more efficient. And so you're seeing some businesses be able to accelerate a lot faster. I think for investors, the question is, do I focus on my existing portfolio or do I focus on the new portfolio? And I think to the entrepreneurs, I think the challenge is, how can you cut through a lot of the chatter? How can you cut through a lot of the noise around investors that are really a little gun shy right now and are really trying to think through what are the next steps? The final point I'll make is I do hope that a lot of the pathways that regional investors, regional entrepreneurs, diverse entrepreneurs have been able to make over the last couple of years, I hope that those pathways stay laid while investors kind of figure out their next steps, as opposed to having to rebuild those pathways sort of once the recovery starts to begin. But I think it's a crazy time, and it's a really challenging time to figure out sort of how should we be investing. But I know, we're by virtue of being early stage entrepreneurs, we've got to be optimists, and we're always excited about sort of thinking that tomorrow has got to in some way be better than today.
One thing that I think is really positive. Oh,
go ahead, Angela.
One thing that I think there's a lot of doom and gloom out there. People are talking about valuations tanking and money drying up. I would just say one positive thing that I think is good for founders and investors. I know that at least Ash will be excited to hear about is I think there's a return to metrics, right? Which is, you're hearing a lot more about revenue quality, right? And I think a lot of us are tired about hearing about, let's just care about, top line growth and profit doesn't matter. And I think you are hearing much more of a focus on things like profitability and really thinking about revenue quality. I'm going to throw 2 resources into the chat window, specifically around just like cash flow management. Like I would say that in the last 3 years, I have not heard a single founder once say accounts receivables. And it's really important, right? Do you collect your balances, net 30 or net 15? It really matters. And I'm glad to hear that we're talking about words like cash and profit and accounts receivables. I think it's really important. I think that helps everybody, investors and founders.
Yeah, just to piggyback on that, profit is the new black, right? Like all of a sudden we're discovering it as investors and as founders in a big way. And from our perspective at Zebras Unite, that's a really welcome development that we're seeing many more investors and founders paying attention to revenue growth and sustainable revenue growth at that. And we're seeing a marked uptick in interest in things like revenue-based financing, right? And revenue-based instruments. And we ourselves at Zebras Unite, when we look at the fund, we were just sort of in the middle of the diligence of building our own fund model. We're feeling completely validated and vindicated, right? That there's a need and appetite for innovative revenue-based models now that we can play on.
Interesting.
So just to go back to what your original question was, is how do you think that this is going to impact diverse founders during this time? Our firm, and I think a lot of firms we're not closed for business, but we're focusing on our existing portfolio companies, and we are having conversations with new companies. But I think it's very, very difficult in this environment when we have no visibility to try to create a really fair valuation, one that's fair to us and one that's fair to the founder, given that we cannot predict growth rates at this time. So I think while we're going to see, especially in a slowdown, we're going to see, what we call the flight to quality, which, unfortunately sometimes means less opportunities for diverse founders. And I don't want to lose that ground that diverse founders have gotten to date. Flight to quality means investing in the guy you know. It means investing in the person that has built a business before, that you knew, that you backed before. And obviously those are going to be more traditional teams. So that's going to close out the opportunity for diverse founders. But I'm sure everyone has heard this a million times, never let a good crisis go to waste. And one of the most important things is building a relationship. And there's no better time to build relationships with people within venture capital firms than now. Like, David looks to people all across the country. Wow, what a great opportunity for people across the country now to connect with VCs, because they don't have to fly to New York. They don't have to fly to San Francisco. They can do a Zoom call from their living room. So I think for the founder that is really creative and scrappy and doesn't reach out and say, hey, are you funding companies right now? If you're not, I don't want to talk to you. But if they're saying, I'd love some advice, or we're thinking about putting more cash into this space, would you mind spending 5 minutes with me to talk about it? Those are the calls that are going to get connected, and then you will have that all-important relationship when this is leveled out.
That's really interesting, because both you and David talked about making that decision. What's best for us as a fund right now? Is it to keep nurture the relationships that we have, or is it to still do what we're out there to do, which is make an impact on new, underrepresented founders? So I guess my question would be, do you think this is a good or a bad time for entrepreneurship? Like, we know that after the Great Recession, we saw a decline in entrepreneurship. Will this pandemic, this shock to the system, is it a good time to be an entrepreneur seeking funding right now?
I think it's always a good time to be an entrepreneur. Sorry.
Go ahead, Tracy, please.
But if you have a great company that is solving a real need, and that's always been the case. Traditionally, the last 4 years, we've seen it's been a good time to be a mediocre entrepreneur.
Yeah, I would slightly separate the question as whether or not it's a good time to be an entrepreneur, or whether or not this is a good time for entrepreneurship. Because I think the answers are a little nuanced. Because I do think that more than anything, thanks to a lot of attention on regional entrepreneurship and how important it is, which wasn't necessarily as prevalent in 08, 09 as it is today, recognizing that it's really important for communities like Portland, communities like Madison, Wisconsin, to have their own local entrepreneurship ecosystem with the right universities in the mix, the right companies in the mix, the right investors in the mix, even some of the public, the government in the mix, and recognizing how important it is to harness the talent that's either grown up or educated locally, and perhaps is seeking to return back home after having worked in New York, having worked in the Valley. I think it's really important, and I think that those ecosystems have grown and flourished. I mean, even in the technology world, I mean, Techstars started in like 2006. 500 startups didn't start until 2010. So the tech community in general kind of was born out of the last recession. I do think that there will be these ecosystems that recognize the importance of startups in the entrepreneurial world and in the business world. So I think that that's good. But I agree with a lot of the things that Tracy said. Like this is a great time to be an entrepreneur or even a wannabe entrepreneur who's working in a big corporate tower, but you've got the idea and the domain expertise and even a lot of the networks to solve real problems. Probably not a great time to be a dating app entrepreneur, but if you're solving real problems, or maybe it is given where everybody's locked in and there's no real world dating happening. But seriously, those that are solving real problems, I think will be able to come out of this, feeling pretty good about their business opportunities.
And maybe even better because there's less noise, right, David?
Yeah, and as Angela and Astrid focused on, like a real focus on business opportunity and not just hype. And so I think that's what investors are really going to start to look for. And I even think a lot of customers. I mean, one of the things, part of the guidance that we've given our portfolio is think about your customer's customer and your supplier's supplier and how their businesses are going to be affected by this. And so I think that the domain expertise really lends to looking sort of much more holistically at the business opportunity.
Yeah, I think maybe ripping on that point on the business opportunities, right? I think I'm an economist by training. I don't think this is a shock. This is not a shock. This is a big reset. It's a step change in how our economies and societies will work coming out. And the coming out of it will not be overnight. It'll take 2 or 3 years of sort of rolling adaptation and public health measures and so on and so forth. And so it's a good time to be an entrepreneur who's solving systemic problems and who is maybe innovating or inventing new categories, right? Where we're solving for a whole new raft of opportunities that didn't exist in February, but exist now, right? Like you can look at the whole field of supply chain management, for example. Hello, right? Toilet paper, who knew that was going to be a problem? But guess what? There's a huge opportunity around innovation in supply chains and distributed mesh networks for making and delivering the things that we all need to eat and exist well, right? So I think we're going to see a ton of category innovation coming out of this. And that will also require a different type of investor, because nothing against venture capitalists, right? But venture capital as an industry has gotten very set in its ways and is having a hard time now seeing a black swan, even if it bites you in the face. And so it's actually an opportunity to renew these sort of mechanisms for investing, along with what I think will be a great wave of new, not just new businesses, but new industries that are born out of this moment.
Did I hear someone say full ratchet?
Angela, was there something that you wanted to add?
I would just add maybe a contrarian reason why I think it's a good time to be an entrepreneur, which is you're going to hear no a lot more. And that sounds like potentially a bad thing. But if you look at the data the last several years, and we all know how crazy and frothy everything got, if you raised a seed round, you only had like a 7 to 10% chance of raising a Series A. And that means that there were a ton of false positives in the ecosystem. And a lot of that's going to go away, which in the short term is going to feel sucky for founders. But it means that, you're not going to waste 18 months of your life working on an idea that you shouldn't have gotten funded in the first place. So I think the reduction of false positives is a great thing for everybody.
So that's an interesting thing to bring up, because you're talking about what it's like for entrepreneurs right now and having to really like figure out if their product is a good product and really working it so that they finally don't get a no. But what about from the investor perspective? So what are you guys doing in terms of picking out the black swans, the products or the people and the companies that have a lot of potential, but distinguishing them from ones that are just important right now during a pandemic and ones that will last for years and years and years as a product people will always need?
I think we're seeing so many changes in the way people work, the way people interact with each other, the way they communicate, the way that they're buying things. So we have to be mindful of all of those, because I think that those are not just temporary changes. I think those are going to be for long term.
Okay. David, you're muted. I can see you trying to talk.
Sorry, yeah, story of my life. I think that we are looking sort of thematically a lot more as opposed to sort of esoterically at individual companies. And so kind of like Tracy's piece around the aging, I think that we're looking and we're seeing, you know, Astrid mentioned sort of supply chain and logistics as a thematic industry that's going to be affected and sort of have a permanent, likely permanent say in the future. I think obviously pathways like education are totally affected. Workforce development, I think, is the one, if there's one that I put a silver bullet in, because these recoveries are also sort of uncovering sort of the skills gaps that have been created by both big and small industries from shore to shore. And I think that we're going to see a lot of companies built and starting to assess, to address and access workforce development challenges, and really that will be born through a lot of public-private partnerships. But I also think that there's some other, like, you know, the home as a platform is something that we're really interested in thinking about, because you look at businesses like Peloton, like esports, like the streaming wars that are really starting to take off. A realtor friend emailed me saying searches for pools are up 3x what they were, you know, before the recession. So people are really thinking about like nesting and how that's going to open up some really interesting opportunities. So I think as investors, we've also got to broaden our aperture. It's not all about sort of the next really micro B2B SaaS point solution, but about some transformational businesses or some industries that have the opportunity to be really transformed through technology, through innovation, through entrepreneurship.
Did everybody see the headline that Walmart is selling tops at 3x the time of pants? We should all be investing in shirts right now because we're all wearing PJ bottoms right now.
That is brilliant.
That's great. And I saw luxury goods are down too, because, you know, there's no place to show them off, right?
Yeah. But then you think about like automobile sales. You know, when has any of us been in an Uber or on public transportation? And I think that's one of those that for the environment, you know, Uber and the promise of Uber plus public transportation had such great benefit to reducing cars off the street. But now with social distancing, the last place I want to be is in the back of an Uber or on a metro car going fast, and would much rather, you know, be in my own Prius or Tesla or whatever vehicle going from A to B. So I do think that there will be, in even things like, I said this a little bit about the home being as a platform, but like urbanism, you know, people who have small kids who live in small apartments, I think, you know, home sales are likely for those who can retain their employment are likely to change a little bit, or people wanting to leave the big urban centers and maybe go back out to the suburbs where there's a little bit more space to stretch your legs. I think we're at the beginning of really some transformational change in the way that we think about both our work and our home life, and how all of the different manifestations of that sort of play out.
So if I'm hearing you correctly, your advice to investors would be to look at it more thematically and to see,
Yeah, as opposed to, like, you know, we all see lots of different ideas come across our desks every day, and I think that it's easy to sort of thumbs up, thumbs down on the individual pitch. But I think it's more thinking about how does this particular company, this particular solution, this particular business opportunity affect the larger ecosystem, the larger industry group, in a way that's ready for, you know, the way that we're going to work and live going forward.
Great. Okay. We talked about if it's a good or a bad time for entrepreneurship right now. What do you think about a new investor, you know, diving in and starting their investment career? Do you think this is a great time or the worst time for someone to begin a career in investing?
I guess it depends if you're an LP or a GP. Sucks to be a GP right now. And I say this as somebody who's just, you know, about to launch a fund, and it's going to be interesting, I would say, stepping out there, you know, with a value proposition and a thesis around some of these thematic areas that we talked about, and the notion of building an entrepreneurial ecosystem as part of your fund activity.
So for anyone who doesn't know the difference between an LP and a GP, can you explain that?
Yeah, the limited partners have the money, have the funds, the assets. The GPs spend the assets, make the investments. And so typically as a fund manager, you have a little bit, depending on particular what fund model you employ, you have a little bit of skin in the game, but really your job is to run around and persuade other people to give you the capital that you then invest on their behalf. Sorry for the jargon.
Oh no, that's fine. I just want to make sure that everyone listening can keep up.
One of the things we have observed in the investor ecosystem among impact investors in particular, I think there are two schools of thought, right? Like there's one that has just become really risk averse right now, and everybody's sort of retrenching and saying, oh no, now is a time when I need to preserve my assets, my portfolio as is, and is very, very reluctant to do anything. And then you have the exact opposite of the spectrum that we observe, where people are really interested in, oh, wait, there are all these sort of micro laboratories. Like, let's see what I can do by just making a relatively small investment at a point in time where an entrepreneur is pivoting or is, leading the company, because it really reveals people's grit and resilience, right? You can learn a lot about an entrepreneur at this time. And so we see quite a few investors actually doing the exact opposite and being very aggressive, especially with early stage investments. I don't know if that's been your experience, Dave and Tracy.
Tracy? Yeah, please.
Sorry, we're sort of right in the middle, as I explained at the beginning. We're halfway invested in our fund. So for the first investments, of course, we're nervous when David tells me he's not going to get into an Uber again. It makes me very nervous because I have an investment in a company called Hop Skip Drive, which drives children and the elderly. So I hope that the elderly and children will feel comfortable getting into someone's car again. But then on the flip side, I have this dry powder, and I am really hoping for a couple things. Valuations will come back to reality, because we were consistently seeing deals, especially high quality deals, were wildly overpriced, in my opinion, especially relative to public market benchmarks or places that we felt that we could comfortably exit the company. And in order for us to make a positive return for our investors, each company that we look at has to have the potential to return 10 times the initial capital that we put into it. And that was getting more and more difficult for us. We're looking hopefully at a better time for that. And then second, what we touched on as well, the noise. One of the reasons that we were so driven into a thesis was because there was no way that we could evaluate all of the potential companies that we were seeing at any given time. It was I'm sure David and Angela, you guys see so many more, but we're just a two-person firm, and we were seeing over 600 deals a year, and that's just way too many spaces for us to be experts in. And so anybody who's out looking for capital, one of the things that I would advise you to do now is take a look at VCs that have a certain expertise or proclivity for the space that you're in. If you're in the future of work or if you're in education, take a look at those VCs that have already invested in that space, because they'll be the best ones to give you advice on what you're doing. But then also too, might actually take an interest in your company versus if you are in a consumer, if you're talking to an ed tech fund and you're a consumer product. It's just, there's not going to be any connection.
And what about from your perspective as the investor? And Angela, sorry, I'll get to you in just a second, but as the investor, how are you making those decisions with 600 opportunities coming your way? What are the qualities and the factors that you're looking at to make decisions about what makes a good investment for you based on, one, your fund, but also the impact you're trying to make?
One of the dirty little secrets is some investors like myself don't invest in deals that come to us. I always say it's the calls you make, not the calls you take. So I am actively out seeking companies within the thesis that we have built. If we have built a thesis around insurance for the aging, I'm out there looking at every single company in that space. If I'm looking for example, transportation for the aging, we looked at every single company that had a focus on driving or transporting people who were over 50, and ended up investing in a company that actually was more focused on kids. But guess what? The person who's making that call and booking the ride is also booking them for their elderly parent as well. So we're very proactive in our approach, rather than trying to sift through everything that comes to us. I mean, we look at, don't get me wrong, we look at it and we love to get deal flow, but it's more along the lines of what we're really truly interested in.
And Abby, you asked about like starting a career as an investor and what would it be like? And it's something I always think about, because do you want to be in the industry during times of plenty or times of want? And I think it's always a great learning opportunity because I mean, over the last couple of years, you know, just about anybody could have called themselves an investor because there was just so much hype. And I think that the ability to learn the industry and learn the fundamentals, I think it takes a cycle or so to learn and appreciate those fundamentals.
100% agree.
And so I think that particularly, I don't want to say younger people, but new entrants, new investors that are learning this business, I think this is a wonderful time for them to learn. I think it's going to be hard because the chairs don't open that frequently, and as Astrid indicated, it's really going to be hard for funds to get closed. But I think working, you know, if I were a young man or woman looking to get into the industry and could find a way to a small fund, this would be a phenomenal way to learn how to apply real valuation techniques, learn how to really sort of understand crucially product market fit and the implications of that for building great sustainable businesses. It's hard to find a job as an investor. It's hard for investors to raise funds, but this is such a cool time, I think, to come into this industry if you're new and thinking about it.
Angela, I'd love to go. Thank you, David. That was really interesting. Angela?
Actually, nothing to add beyond what all these very bright people have already shared.
Okay, great. All right, so we have a couple of questions from people watching. I'm just going to read a couple of these. Well, first I had a question a little while back from, I can go into a Q&A file here. Yes. From Chino Aponte. How has the pandemic affected bootstrapping versus taking on an equity investor for your operation, and which option is better?
So I would say that the pandemic shouldn't actually change that. So I think for too long, the default has been, I'm going to raise venture capital funding. And I think the default should always have been, I'm not going to raise venture capital funding unless I need it. And I think that has not changed. I think what's happened is more people are becoming aware of that because VC is harder to raise right now. But I think that venture capital should only be raised if it's truly needed. And I would argue that 1 in 4 companies that approach me, my response to them is you should not be raising funding. So that's just a general statement. And then the other thing I would say more tactically is VCs invest in industries where you need a really high customer acquisition dollars and funding. And so when it's a customer acquisition machine and you know your customer acquisition cost and you know your customer lifetime value, and your customer lifetime value is 3x out of your customer acquisition cost, and you know that there is a race because this is going to be a winner takes all market, that is appropriate for venture capital, where you need to spend millions of dollars to acquire customers and you need to beat your closest competitor, and that's what's going to win the race. That's a company that's appropriate for VC.
Yeah, at Zebras Unite, we're actually working on some navigation tools to help founders and investors answer that question a little bit more easily, because as Angela said, too long the default has been, oh, I'm just going to raise a round. And bootstrapping has been poo-pooed as sort of, oh, you must be building a lifestyle company. It's like, no, what if I'm building a company that I just don't want to lose control of? Like the moment you step on that VC treadmill, it's very difficult to maintain control and ownership as a founder. And one of the things that I embrace in this moment, and I think Angela alluded to this earlier, is that it really forces you to pay attention to fundamentals, like the fundamentals of your business, and really understand like every cost line item and every revenue line item on really, really carefully.
Well, and understanding those line items, it's understanding your cost of capital as well, right?
Exactly.
You know, sometimes I joke to people, I say, go put it on your credit card because I want 40%.
Exactly.
All right, thank you, Chino, for that question. So let's go back a little ways and talk to us about what it was like back when you were investing in during the Great Recession, or even all the way back to the dot-com bubble burst. If you were engaged in investing at that time.
You're going to out us on our age, Abby.
That's why I left it open. If you were there, if you remember.
If you were there.
Thank you.
Yes, of course. I mean, I remember them, if that helps. We can all be in this together. So yeah, talk to us about that. Talk to us about what it was like during those times, and if they were different or the same or similar to now.
I was a partner with Baker Capital starting in 1999. So that was, boy, that was interesting. And it's really informed the way that I have been making my investment decisions now, having gone through that and having gone through 2007 and 2008. I think we rebounded a little more quickly in 2007 and 2008 because it wasn't so much, it was the mortgage-backed security crisis. It wasn't a tech overvaluation. Oh, sorry, that's not a word, but you know what I mean, that the technology sector as a whole wasn't wildly overvalued. I was at Robertson Stephens, an investment bank before that, and we were pricing companies to go public, 5 of them a day. It was really a disaster. And the backside of that I saw, that was extremely painful personally for me, both, for my personal finances, from the fund that I was a partner in, is that we saw all these incredibly good companies that had great market opportunities and had great teams, but they were so wildly overvalued that then they were recapitalized. And a lot of times we were completely out of the deal of a company that was successful. So having been really burned by that, I have been extremely valuation sensitive. And when I say to a founder, look, I'm sorry, I'm not going to pay 80 times revenue. What's going to happen when you go from 100,000 to $1 million in revenue? Is your company going to be worth $80 million? I don't think so. And I think that all these numbers have just been pegged to sort of what can I get and how much can I raise? And I, for one, am really looking forward to the other side of this mountain. That's for sure.
Go ahead, David.
Go ahead. No, please.
Oh, I was just going to say, I was a founder during the first dot-com boom and invested out of the, Great Recession. Answering it in a slightly different way, I think that the thing that I really took away from it is just that people have long memories. This is a small ecosystem. And I find that sometimes when these things happen, some investors are like, ooh, now I can kind of become like a predatory investor and just become a jerk. And my just advice to everyone out there is
that's
just
not me,
don't be
Angela.
a jerk. No, definitely not, right? But I'm just saying, work with good people. I just think that's good life advice in general. But I find that true colors can come out right now, and you can see how people are negotiating and treating their teams. And I just really pay attention to that because it's the right thing to do, but also because people remember.
Sure.
I guess I would pull a little bit on that thread as well, and just think about, in addition to really good people, this is also a generational time. I mean, we saw it, a lot of our companies that were started in 2008, 2009, and the aftermath thereafter, they were working. They were the CRO or head of sales at big Fortune 500 company, and they said, you know what, I don't want to take the ride again. I could do this better than the company that I'm currently working at, or the contractors that we're paying, and they started their own companies. And we made a lot of really good thematic bets in that period of time. We launched and invested in businesses like Zipcar, which was sort of the grandfather of Uber. And so the ability to think about industry change and starting company formation that's really tackling big problems in transportation and financial services and all of those. I think that it's the learning there was that the incumbents were slow to move. And I think that the incumbents today will also be slow to move and slow to adapt and want to sort of keep fitting, square pegs and round holes. But the consumers, the businesses want new adaptable solutions. And I think that those forward-thinking entrepreneurs can come up with those solutions and find the investment or bootstrap the investment. I think that they'll be very well rewarded as we come out of this recession. So I do think that it's a generational thing as much as it is sort of a be nice and have really lean into the long memory. It's also a time to maybe take a little bit of a leap of faith and go out there and be entrepreneurial and be smart, but be smart and be thoughtful about it. But I think, this is a great time to start a business, believe it or not.
I agree too.
Great, thank you. So this question comes from Kwame, I believe is his first name, and I can't see his last name, Sam Ping Pong. Tracy mentioned valuations being so much higher than public market benchmarks in the past. How are you all digesting public market activity, considering the market's not seeming to follow what's happening on the ground with businesses?
I mean, right. That's another thing too. When I said we sort of are taking a little bit of a pause because the public market fluctuations, up 5%, down 5% every day. Last I checked, the NASDAQ had a really good day today, which made me smile, but it's been tough. And until we sort of have a softening of the volatility, it's going to be really difficult for us to benchmark off of that.
And I'd say that there's just a widening gap between private market security valuation and public market security valuation, just because of everything from high frequency trading and hedge funds moving the market to just hard revenue comparisons that really make it hard on an ongoing basis. I mean, I think we've said it a couple times here. It's really the focus on fundamentals. It's really the focus on sort of quality of revenue. It's really the focus on operational excellence and not hiring people until you need those people to actually really do the job. I think that's how I think about it. I mean, how does that manifest itself into evaluation? It's, at the seed stage where I invest, it's obviously a lot more art than science, but it's making sure that like the fundamental laws of gravity still hold true with all of our investments. And so, just making sure that all of that still checks is how we think about validating, the valuations in which we're investing.
So Astrid has this really interesting subject about zebras. She's part of the fund Zebras Unite, and she has this really interesting approach to investing. It's the difference between what a zebra and a unicorn, and that everyone's looking for a unicorn. This is something that's different and is going to blow up, and everyone's going to be like, oh my God, I can't believe this now exists. But so Astrid, talk to us a little bit about what is your take on zebras who, as you talked to me about in one of our episodes of the podcast, are a little bit more reliable because they're more of a long-term, they're less glamorous, a little less sexy, but well, in your own words, right? I hope. Maybe you didn't say sexy. It's quarantine. I'm getting crazy. Everything seems sexy now. So talk to us, has your approach to zebras versus unicorns changed recently? Like, or do you still believe in the power of investing in zebras versus unicorns?
Oh, completely. I mean, we've completely validated, right? Like I said, everybody's discovering how sexy revenue is. Now there's something that's sexy, right?
Yeah.
Revenue is really awesome.
And financial responsibility is sexy.
And financial responsibility is sexy, right? And some of the kinds of, like I would say, we just completed a survey of our community at Zebras Unite and sort of took an international look at what zebra companies are building. And they are in a lot of these leading, what I would say, next generation, next economy sectors, right? Like, so we have a lot of zebra companies doing really well because they are way ahead of the game building alternatives to Zoom, for example, right? For online meetings.
Well, really quickly, can you, because I don't know that I described it the best way. Will you describe what a zebra company is?
Yeah, a zebra company, I mean, we wrote a manifesto 3 years ago called Zebras Fix What Unicorns Break. And it sort of, on the one hand, makes fun of the VC fascination with these mythical creatures, the unicorns. But on the other hand, really posits just a set of principles for building businesses that are solid and sustainable and also quite ambitious in the long run, right? So they're black and white. They balance profit and purpose. They're collaboratively inclined. They treat their users not as churn, but as a community. They tend to be in industries that matter, not sort of, as somebody said, the next dating app, but solving for things like food systems and healthcare and education and financial systems and so on. And typically we find founders who create these companies don't want to lose control of them, right? So there is sort of both a philosophical, a bit of a philosophical aversion to handing over equity in your company, right? And so it begs the question then, well, what kind of capital do these companies need? What kind of community do they need? What kind of culture do they subscribe to in how they build their businesses and how they treat their employees and how they treat their customers? And so we were just blown away that so many people felt the same way, right? And now we have an international movement and are contemplating this fund to help serve some of these needs.
So now with everything that's going on, do you ever at any time consider investing in a unicorn because it fits this need that has just come up out of the blue?
Yeah, it's not that we don't invest in unicorns. I think we have, so I think the question is, what's the founder's vision for that company, right? So there are a number of companies we're tracking, and I take Tracy's point, right? Like you have a thesis and then you go and find everybody who's in that who's in that category or in that space. And there are some companies we're tracking that we're so excited about who could fit the unicorn description of Silicon Valley, but who may actually benefit from a different form of capital that allows them to grow aggressively and ambitiously, but doesn't lose as much control to the founder. And so that's what we're excited about. I mean, there are some very, very cool category innovators out there that we're tracking. And again, these spaces that I've mentioned, like health tech and food and farms and education and financial systems.
Okay, great. Thank you. So this question I want to spend a good amount of time on, because I think this is really the foundation of Off the Sidelines podcast. So much has been said about how this pandemic and ensuing economic shock will reinforce inequalities in our country. And we talked so much to all of you throughout the season of our podcast about the gaps in people who are getting funded, and how less than 1% or less than about 2% of female investors are finding funding out of everyone, and less than 1% of African-American women are getting that kind of funding. And we know there's all sorts of terrible statistics like this showing that gap. Do we think that the pandemic is going to reinforce those inequalities? And do you think there's any investment class that can play a role in changing that?
Yeah, I hope we don't lose ground in that space. But as I said in the beginning, sometimes it's easier to fund a company of a guy that you've backed before with a successful exit. So so it could be not that we've really even made any progress. We've made some, but it's so de minimis in terms of numbers of people who've been funded who are diverse, and total dollars, because that's another metric you need to look at. Not just did they raise a Series A or a seed stage round, but how much relative to their peers, because you can do a lot more with $5 million than you can with $1 million. And I think we've made a lot of progress in terms of with all the accelerator programs. Like, shout out to UBS Project Entrepreneur, who has been one of the leaders in this space. But it's still going to be tough. But I think it's it's going to be tough for anybody trying to raise capital in this atmosphere. So.
Yeah, I think a lot on this, and I think that, from the most macro, there's never been more private capital available to be invested. I think that capital, it's going to be hard pressed to get that capital into public securities, because the government's paying like 0% interest. It's going to be hard to get that. It's going to be hard for that capital to really see a lot of value in topsy-turvy public markets. And so, I think that there is still opportunity in private markets. I think for diverse entrepreneurs, for women entrepreneurs, for LGBTQ entrepreneurs, I think the shock of the pandemic is going to cause a lot of those investors to retreat and sort of focus on what's in front of them. But I think that, again, like Tracy, I hope that the long-term, the pathways that have been built will be able to be I feel like a lot of the people on this call and lots of other people have dredged the pathway to allow for that capital flow to reach new places. And I hope that path that has been dredged can fill quickly, because we know sort of where those pockets of entrepreneurship are. We know the startup support organizations that are needed to help support and lift up those entrepreneurs. And frankly, the problems aren't getting any better, right? The pandemic has exposed lots of gaps and lots of problems where the lived experience of a lot of African-American, Latinx, women, LGBTQ, Native American entrepreneurs can be directly impactful to people and businesses and communities. And so I hope that those people, I hope that the capital takes the risk, and I hope that the entrepreneurs continue fighting the good fight, because there is the mismatch that I think more than anything we're seeing in education and in workforce development and healthcare that is really being exposed by, even in sort of connectivity and access to high-speed internet, that's being exposed by the pandemic. So I'm optimistic, I'm hopeful, but I think it's going to take a while for the shock to sort of work through the system.
Yeah, I think that's where we have it. Sorry.
No, go ahead, Astrid.
I think that's where we have an interesting opportunity for some public investors and philanthropic investors to help catalyze to some of those new flows of capital that you just alluded to, David, and help underwrite and get off the ground some, frankly, new financial institutions that we're going to need, right? I mean, we all just woke up all at the same time, right, to the broken financial infrastructure in this country. Like all of a sudden, it's right in front of all of us. And that, again, is one of those huge opportunities for innovation and entrepreneurial interventions. And we're excited to be working, for example, with something we're calling the Inclusive Capital Collective, which is a group of over 70 community-based lenders and technical assistance providers who are now beginning to basically build shared infrastructure and shared services. And that's and have a national reach, are in community, and are basically small enough as capillaries, right, to reach into those communities. But then on the other end, point a large funnel towards mainstream investors and say, here's where you can deposit your large chunks of institutional capital, for example. So I think we're going to see a lot of, or I'm hopeful, I should say, for sort of capital innovation and capital entrepreneurism, if you will, to help bridge that gap.
I just wanted to share a couple of practical things that all of us on this call can be doing. So the first is, and we stole this from Angels, so we didn't come up with it, but Angels is an LGBTQ angel network in New York City. And when they invest, they have their founders sign a pledge that talks about diverse hiring practices. And so we adopted it at 37 Angels. So all 65 of our portfolio companies, when we invest, we give them a one-pager of like, I pledge to do these things, to have an inclusive hiring practice, to have an inclusive culture. And it's very tactical things, right? So like, how do you write an inclusive job description? You throw it through text.io. How do you, anyway, so that's a whole one pager that we do. And I think that we should all be doing that as we're investing. So that's one. The second is something that I think we can learn from. There's a website called Hypatia Invests. And again, I'll put this into the chat window. And they've basically listed a bunch of funds that are either run by female fund managers or that are investing in female-focused endeavors. And I think there should be something similar where, like, if we wanted to give money towards, racially diverse fund managers, how would we do that? So that's the second one that I think we could learn from. And then the third is I think we should all be learning how to be investors and joining communities that are gathering of this source. And again, I'll put this into the chat window, but just like 3 resources to learn how to be an investor. One, if you just have a tiny bit of money to invest, there's a great group called SheEO, and they are doing interest-free loans towards founders, and they focus on women, but they're quite racially diverse as well. 37 Angels, we teach you how to be an angel investor. We have a boot camp. And then there's Portfolio, which basically allows you to be like a mini fund manager in a mini fund that you help to raise. And it's all about trying to change the gender and racial gap, diversity gap, I should say, on the fund manager's part. And then there are funds that are focused on this already. One is, Digital Undivided, which I'm sure everyone knows. Catherine Finney runs that. And then there's New Voices Fund. And both of those groups are focused on supporting, I believe, Black female founders. But so there's a lot out there already. So I just wanted to share some of them. I'm going to start typing in the chat.
If you could add that to the chat, that would be amazing.
Yeah.
We are out of time, so I want to thank all of our wonderful panelists. Thank you so much for the time and for all of the candid advice and insights. And always a pleasure to speak with you all. And if anyone is interested, they can listen to the Off the Sidelines podcast, which Christopher Wink posted at the beginning of this chat, posted the link to. We have some articles about it on Technically Philly. A recording and a recap of this exact panel will be on Technically, so you can check that out again as well. And also like to shout out to Terry Laban, who is doing the digital drawing. Sorry, I'm not finding the exact words. Yeah, from Breakthrough Visuals. So thank you to everyone who joined, and thank you for everyone who watched, and have a great day.
Great. Thanks so much, everyone.
Thank you. It was so much fun.
Bye.
Bye all.